You're not dealing with rising prices. You're standing inside a system that has already activated its formula, a formula that has repeated itself in every inflation nightmare ever recorded. People think inflation is random, triggered by bad policy, bad luck, or unpredictable shocks. That illusion is the first trap. The truth is far harsher. Once the pattern starts, it moves through the economy with the same rhythm, the same escalation, the same psychological reactions, the same final impact, no matter the country or the decade. You're not watching a new crisis. You're inside an old one with a modern disguise. And the part nobody admits is that the pattern doesn't just unfold. It accelerates because citizens, governments, and central banks push it forward without even realizing it. Every inflation disaster begins long before people notice anything. It always starts in the quiet period when governments assure the population that nothing is wrong. They say prices are stable, debt is manageable, growth is solid. They rely on the fact that people accept official statements over silent evidence, that silence hides the earliest movements of the cycle, the kind that look harmless until it's already too late to slow them down. In Weimar Germany after World War I, the public heard constant promises that money printing was temporary and controlled. In the 1970s, United States, officials insisted that inflation was transitory decades before the word became fashionable again. In Brazil, before hyperinflation detonated, the government repeatedly claimed that their price controls were working. Zimbabwe followed the same pattern, insisting that new banknotes were temporary emergency measures. Every one of these reassurances was delivered during the phase when the system had already shifted into the pattern, even though the population couldn't see it yet. This phase always starts the same way. Governments attempt to solve a financial strain by expanding the supply of money, either directly or through debt they can never repay. They justify it with national emergencies, recessions, wars, political instability, or promises of future prosperity. They never admit the real motive, survival. When governments enter survival mode, the public becomes the collateral. They mask monetary expansion behind calm statements. They insist nothing fundamental has changed. And the people believe it because the early price movements are small enough to look insignificant. This is the period when citizens think inflation is just a temporary inconvenience. They don't understand they've already stepped into the sequence that every collapsing currency follows. Once the first quiet shift happens, the next stage begins with subtle pressure. Prices start moving in ways that people notice but dismiss. Food costs a little more. Rent nudges upward. Savings buy slightly less. Nobody panics because nothing feels unusual. This is the same point where Americans in the early 1970s shrugged off rising gas and grocery bills, where Brazilians in the early 1980s told themselves it was normal for prices to change slightly each month, where Zimbabweans in the early 2000s still believed their currency could recover. This stage depends on complacency. People believe they're witnessing normal fluctuations, so they continue living the same way. Meanwhile, governments push deeper into the pattern because they know the public hasn't reacted. They expand spending, they borrow more, they manipulate interest rates, they keep promising everything is under control. That promise is the fuel that drives the pattern forward. During this stage, central banks always try the same set of actions. They adjust interest rates with slow confidence, pretending they're managing expectations. They publish calm statements filled with technical language designed to make the public feel safe. They conceal the pressure building underneath the system. The pattern gains momentum because each small increase in prices creates a psychological shift. People accept the new normal. They adapt to higher costs. They stop questioning why currency is losing value. And this acceptance becomes the trigger for faster movement. Inflation is no longer a silent shift. It begins feeding on itself. Then comes the moment when the public finally senses something is wrong. It always happens after enough small changes accumulate into a noticeable impact. Suddenly, the cost of living doesn't just feel inconvenient, it feels heavy. People start adjusting their behavior. They buy earlier, they stock up. They panic slightly without admitting they're panicking. In every inflation disaster, this is the transition where the pattern becomes visible in daily behavior. In Weimar Germany, people rushed to spend their wages before prices jumped again by evening. In Brazil, families began buying durable goods instead of holding cash. In Zimbabwe, shops saw customers hoarding basics the moment shelves were restocked. The United States in the 1970s experienced the same behavioral shift when wage demands escalated and people began losing trust in the dollar's stability. This stage is where the psychological component breaks open. People stop believing official statements and start believing their own eyes. Governments react with the same predictable panic. They accelerate their actions instead of slowing down. They push out new economic programs, new subsidies, new controls, new promises. They blame external forces, foreign nations, supply shocks, corporations, or temporary disruptions. But the pattern has already passed the point where explanations matter. Every attempt to stabilize the situation ends up creating more instability because the core problem hasn't been addressed. Too much currency chasing too few real assets. The more governments intervene, the more pressure builds. Price controls don't stop price increases. They just push them into the shadows. Subsidies don't calm the economy, they feed the same monetary expansion that caused the crisis. The pattern moves forward regardless of who is in power or what ideology they claim to follow. At this point, people think they're experiencing the worst of inflation, but they're wrong. This is only the midpoint, the moment where everything feels chaotic, yet still manageable. This false sense of control is part of the pattern. It convinces the public that the government can eventually fix things. It convinces them to endure a little longer. And during that endurance, the system transitions into a deeper phase. In Weimar Germany, currency printing accelerated until the paper used to print money was worth more than the money itself. In Brazil, wages had to be renegotiated constantly just to keep pace with prices. In Zimbabwe, everyday transactions moved from currency to barter. These transitions happen because the population slowly realizes that money is no longer a tool for storing value. It has become a tool for escaping loss. People spend faster, save less, and trust nothing. The behavior becomes frantic, even if people pretend everything is normal. This is when the pattern becomes dangerous, not because prices are rising fast, but because trust is falling faster. Inflation is always a story of collapsing trust disguised as rising prices. When trust breaks, people stop believing in tomorrow's value. They stop believing in government assurances. They stop believing that stability will return. The government senses this shift and reacts with desperation. They blame speculators, retailers, foreign nations, political enemies. They create new laws to control prices, wages, imports, and money movement. They threaten businesses that raise prices. They impose strict measures to signal control. But every restriction signals the opposite, that the government has lost the ability to stabilize the currency through normal means. Once trust collapses, the pattern enters the stage that feels like normal life being squeezed from every direction. Prices move so fast that people adjust their behavior daily. Salaries lose value before they're spent. Families switch from long-term planning to survival planning. Businesses struggle to calculate costs. Investors flee. And the government continues expanding money supply because they have no alternative. Debt becomes unpayable without printing. Deficits become unmanageable without printing. Social programs collapse without printing. At this point, the currency is no longer in trouble, it is trapped. There is no path back to stability without severe consequences, so governments choose short-term survival again. This drives the system into the next transformation. The transformation is always the same. Inflation becomes self-reinforcing. Prices rise not just because currency is devaluing, but because everyone expects them to keep rising. People raise prices preemptively. Workers demand higher wages preemptively. Businesses buy inventory preemptively. Expectations replace economics. And once expectations dominate, inflation stops behaving like a financial issue and starts behaving like a social force. It accelerates because the entire population is acting in the same direction at the same time. This is what happened in Weimar Germany before the collapse. It happened in Brazil before stabilization. It happened in Zimbabwe before the currency died. People move faster than the government can react. During this period, governments always attempt extreme measures. They freeze prices. They freeze wages. They impose rationing. They create new currencies. They redenominate money. They introduce emergency controls. Every one of these actions signals the same truth. The system has reached the point where normal tools have failed. The population understands this instinctively. They begin shifting to foreign currencies, assets, commodities, barter, anything that holds value better than the national currency. The shift doesn't happen because people want to abandon their money. It happens because their money has abandoned them. Once this psychological break happens, the pattern enters its final movement. The final movement is where inflation stops being an economic problem and becomes an outright collapse. Prices move too fast to track, salaries become meaningless, savings evaporate. The currency loses credibility, not gradually, but abruptly. This is when the public realizes the warnings they ignored were not exaggerations. They were predictions. Every country that has reached this point experiences the same final impact. In Weimar Germany, the mark collapsed so violently that people needed wheelbarrows of cash for basic goods. In Zimbabwe, the dollar devalued until it became worthless. Brazil survived only through radical currency reform after years of chaos. The United States avoided hyperinflation in the 1970s only because extreme interest rate hikes crushed the economy to break the cycle. These outcomes differ in severity, but the pattern underneath them is identical. The final movement doesn't feel like a dramatic explosion. It feels like a silent verdict. People wake up one day and realize the value of their money has crossed a line it can return from. They see the truth that was visible for years, but ignored because the changes were gradual. They recognize that inflation was never a temporary disruption. It was a sequence that moved through familiar motions until the currency's credibility snapped. At this point, no intervention can restore value. The collapse isn't reversible because trust isn't reversible. Governments can print money, but they can't print belief. And this is the moment people finally understand what the inflation pattern really is. Not a series of price increases, but a system-wide breakdown of value that always started long before anyone recognized it, always accelerated when authorities denied it, always intensified when citizens tried to escape it, and always ended at the same destination. People convince themselves they'll see the danger coming. They won't. The early movements are always quiet. The midpoint always feels manageable. The acceleration always feels temporary. And the final stage always arrives faster than anyone is prepared for. The pattern is repeated across centuries, governments, ideologies, continents, and economic systems. It doesn't care about politics. It doesn't respond to speeches. It doesn't stop because people are tired of it. Once activated, it follows the same pressure points until the currency, the system, and the population reach the same conclusion. Inflation doesn't destroy money. It exposes that money was already in danger. The governments that deny this truth accelerate the collapse. The citizens who ignore it become participants in their own devaluation. And by the time the final movement arrives, the economy is no longer fighting inflation. It is fighting the consequences of pretending that inflation was harmless. Every country believes it is different. Every population believes they will avoid the collapse others faced. Every leader believes they can manage the pattern better than those before them. But the pattern does not care about belief. It cares about behavior. And the behavior is always the same. Expand the money supply, reassure the public, watch prices drift upward, watch trust drift downward, intervene aggressively, accelerate the damage, lose control, and face the final impact. The sequence has never changed. It is unfolding again right now, disguised beneath statistics, statements, and carefully controlled narratives. The public thinks they're witnessing mild inflation. They think the system is stable. They think the authorities still have options. They think history won't repeat. But the pattern is already moving, and once it moves past a certain point, nothing stops it. Not policy, not promises, not hope. This is the truth every inflation crisis eventually reveals. You're not watching prices rise. You're standing inside the formula that ends the same way every time. And the final movement has already begun.